Hey everyone, Suze Orman here. Today, we're diving into the exciting world of options trading. Don't worry, it's not as complicated as it sounds. We'll break down a popular strategy called the Caelndar Put. I'll explain everything in plain English, so you can feel confident using it. Options trading can seem intimidating, but it's a powerful tool for generating income. It's like having a side hustle for your investments. With a little knowledge and careful planning, you can use options to boost your returns. Ready to learn more? Let's get started. The Calendar Put strategy is a bullish options play. This means we're expecting the underlying stock to either go up or stay relatively flat. We're not looking for a huge drop in price. This strategy involves selling a put option with a closer expiration date and buying a put option with a further out expiration date. Both options have the same strike price. This creates a calendar spread, hence the name Caelndar Put. The goal is to profit from the difference in time value between the two options. Don't worry, we'll explain that in more detail later. For now, just remember that we're using time decay to our advantage. One of the best things about the Caelndar Put strategy is that it offers capped risk and capped reward. This strategy is particularly appealing to traders who want to have a clear understanding of their potential financial outcomes before they even enter a trade. This means you know exactly how much you can potentially gain or lose before entering the trade. By having this knowledge, you can make more calculated and confident trading decisions, reducing the anxiety that often accompanies market volatility. Your maximum risk is limited to the difference between the premium received for selling the near-term put option and the premium paid for buying the longer-term put option. This difference is crucial because it defines the net debit you pay to open the trade. The net debit is essentially the cost of entering the trade, and it is a fixed amount. This fixed cost provides a sense of security, as you know that your losses cannot exceed this amount, no matter how the market behaves. This is the net debit you pay to open the trade. Understanding this upfront cost is essential for budgeting and planning your trading activities. Your maximum reward is the net credit you received when you opened the trade. This net credit represents the potential profit you can make if the trade goes in your favor. This occurs if the stock price is above the strike price at the expiration of the near-term option. In such a scenario, the value of the options you hold increases, allowing you to capitalize on the favorable market movement. Knowing your risk and reward upfront is crucial for making informed trading decisions. It allows you to weigh the potential benefits against the risks and decide whether the trade aligns with your financial goals and risk tolerance. It helps you manage your portfolio and avoid costly surprises. By having a clear understanding of your capped risk and capped reward, you can better strategize and optimize your trading activities, ensuring that you stay within your financial comfort zone while pursuing profitable opportunities. For our example, we'll be using Alphabet, the parent company of Google. Alphabet is not just a tech giant, but a pioneer in various fields, from search engines to self-driving cars. It's a well-established company with a history of consistent growth and innovation. This makes it a good candidate for the Caelndar Put strategy, a popular options trading strategy. Let's say Google is currently trading at $120 per share. We believe the stock will either go up or stay relatively flat over the next month. This belief is based on recent market trends, company performance, and broader economic indicators. We decide to implement a calendar put strategy to capitalize on this outlook. Here's how it works. We sell one GUG put option with a strike price of $120 expiring in 2 weeks and receive a premium of $5. This means we are obligated to buy the stock at $120 if the option is exercised within 2 weeks. Simultaneously, we buy one GUG put option with a strike price of $120 expiring in 4 weeks and pay a premium of $7. This gives us the right to sell the stock at $120 if the option is exercised within 4 weeks. Our net debit and maximum risk is $2 or $200 per contract. This is calculated by subtracting the premium received from the premium paid. The calendar put strategy allows us to potentially profit from the time decay of the options while limiting our risk. It's a sophisticated strategy that requires careful planning and market analysis, but it can be highly effective when executed correctly. In this scenario, GUG experiences a minor correction, which is not uncommon in the volatile world of stock trading. Market fluctuations can be influenced by a variety of factors, including economic data, investor sentiment, and global events. As a result, the stock price drops to $115 per share by the time the near-term put option expires. This decline might seem alarming at first glance, but it's important to remember that such movements are part of the natural ebb and flow of the market. So, what happens to our trade in this situation? Let's break it down step by step. Since the stock price is below the strike price of $120, the near-term put option we sold will be exercised. This means that we are now obligated to fulfill the terms of the contract. We are obligated to buy 100 shares of GUG at $120 per share, even though the market price is only $115. This might seem like a disadvantage, but there's more to the story. However, we also own the longer-term put option with the same strike price. This longer-term option acts as a safety net in our trading strategy. We can exercise this option to sell our 100 shares of GUG at $120, effectively offsetting our loss. This strategic move allows us to manage our risk more effectively. In this scenario, our loss is limited to the net premium we paid for the options, which is $200. This is a calculated risk that we were prepared to take from the beginning. This is the beauty of capped risk. By using options, we can limit our potential losses while still participating in the market. It's a powerful tool for traders who want to manage their risk and protect their investments. Diversification and strategic planning are key components of successful trading. By understanding and utilizing options, traders can navigate market volatility with greater confidence and control. Always remember to consult with a financial advisor to tailor strategies that align with your individual risk tolerance and investment goals. This ensures that you are making informed decisions that suit your financial situation. In conclusion, while market dips can be challenging, having a well-thought-out strategy can make all the difference. Stay informed, stay prepared, and always manage your risk. Now, let's imagine GUG remains relatively stable over the next 2 weeks, hovering around the $120 mark. As the near-term put option approaches its expiration date, its time value will erode. If the stock price remains above the strike price, the option will expire worthless. We keep the premium we received from selling the near-term put option, which is a profit of $500. We still hold the longer-term put option, which we can either hold on to or sell to close out the trade. This scenario highlights the income-generating potential of calendar puts. By selling options that expire worthless, we can generate consistent profits. What if Gouge exceeds our expectations and surges to $130 per share? This is the best-case scenario for our calendar put. The near-term put option will expire worthless, and we keep the entire premium received. The longer-term put option will decrease in value, but we'll likely sell it to lock in our profits. Our maximum profit in this scenario is the net premium received from selling the near-term option, which is $500. Remember, our reward is capped. Even though Gouge skyrocketed, we don't participate in the full upside. This is the trade-off for enjoying capped risk and receiving income. That's it. Thank you for watching. Good trading, and do not forget to like and subscribe.